All right, good morning, guys. Chapter 18, we're clicking them down now. We're almost at the finish line. So once we cover chapter 18, and later today we will cover, or later this morning, because this will not take long, chapter 18 is very short. Then we'll cover chapter 21, and that will, for the most part, wrap up any math in the class. Once we get through chapter 21, that's the end of the road for math. There's a reason I jump ahead and finish the last of the math, because I want to send home with you today the math review packet for the whole class, so that because today you're 2 weeks away from the final exam. So that gives you 2 full weeks of time to work on that math review packet. I find that math is just all about the practice, right? How many times you repetitively do these things. So I want to send you home with that math review packet in plenty of time so that you have plenty of time to work over it. That's why we'll do 18 and then jump ahead to 21. We will come back and pick up chapters 19 and 20, which are fair housing and environmental issues. And then that's it. That's, believe it or not, that's all of the information. So just kind of, remaining schedule. Today we will do 18 and 21. And then that will leave us with next Tuesday, fair housing and environmental issues, which will probably be done before lunch, quite honestly, or pretty close around there. And then we'll start your review, and we'll review the remainder of the day on Tuesday, and then the following Monday, and then your final exam on Tuesday. So you're there. You're right there. It's right around the corner. I know you're excited, right?
I need a few more weeks.
You need a few more weeks? You're ready. You will be ready. You'll be ready. All right, so things we need to talk about in Chapter 18. Chapter 18 deals with tax issues. What are the tax implications from owning real estate? And there are a couple of different types of tax issues when it comes to owning real estate. One of the first things we have to remind you is, just like you're not an attorney, you're also not an accountant. You're not a CPA. So you are not qualified to give tax advice. Unfortunately, your clients, because they're cheap and they don't want to pay for real professional services, expect you to be an expert on all things, everything. They will ask you everything from how much will it cost to put hardwood floors in, to how should I file my taxes, to should I declare bankruptcy? Well, you got to know where the line is and say, that's not my job. I'm not qualified to give that advice. We teach you what the tax implications are of real estate just so you have a basic knowledge of where your clients are going to be coming from potentially, particularly investment clients. This impacts investor clients much more so than it does homeowners. We're going to start with the implications for homeowners, but when you talk about taxation issues, investor clients are much more concerned about that. And if you're not at least aware of the things that implicate investment taxes, then you're never going to have an investor who wants to work with you, because they're going to look at you like you're a moron if you don't understand what their tax situation is. I mean, that's just the honest truth. When they walk up to you and they say, well, I need to do a 1031 exchange, if you don't know what that is instantly, as soon as they say it, they're not going to work with you because they don't feel you're qualified to work with them. So that's really what this chapter is about. It's just about learning the basics of how taxes impact. There's 2 types of taxes that we talk about in this chapter. Annual taxes, which are called income taxes. You pay annual income taxes. And generally speaking, owning property can impact your annual income taxes in a couple different ways. If you own a home, it's going to reduce your annual income taxes because certain expenses related to owning a home are tax deductible. Have you ever heard that expression, things are tax deductible? If we're talking about investment property, then annual income taxes are not going to be reduced by owning property. They're probably going to be what? Increased. Because if you think back, that before tax cash flow, there's a reason we call it before tax cash flow. Because that amount of money is going to be taxed. That is the profit that is generated as a result of owning that property. So it would make sense that that property owner is going to have to pay income taxes on that amount. Does that make sense for everybody? Okay, because that's their income. All right, so let's talk about home ownership. Are y'all chilly? It's chilly in here. it chilly? See, let's put I was wondering.
He says for the first time in 12 weeks.
I think my night class has hot flashes. I think they turn it down when I'm not looking, and I don't. A lot of times I just don't pay attention. But this morning I'm like, it's cold in here. Yesterday it was like a culture shock walking outside because it was cold in here, and then you walk out there and it was 1,000 degrees outside yesterday. Hot.
Night class lessons, wow.
Yeah, you're not.
They are, aren't I? told you, it's the craziest group of people you've ever. We have a blast in that class. I'm going to be honest with you. Normally night classes, I'm like, oh God, here we go. You know, because normally it's people that are tired, but that group, man, they are something else.
They're delirious.
They are, and they're hilarious too. I mean, we have a blast with them, and of course you got to meet Michelle. You know,
Yeah, on that philosopher, she was definitely more vocal.
yeah, she was wound up last night. She was wound up last night.
Yeah, she was like,
She was trying to make something out of a formula, and she was, and I was like, if it helps you, that's good. You know. We love her. She's awesome.
Yeah, you only have one guy in here, so.
JJ's the only guy in the whole class. 25 in the class and 24 of them are women.
Yeah.
That's not, I've never had one that skewed.
Yeah,
Yeah.
JJ is.
The men are always outnumbered. That's very common in real estate classes because real estate tends to attract more women as an industry. You know, people want to get their real estate. I mean, if you just look around and look at the makeup of the brokerage public, it's pretty heavily on the female side of things. So it's not unusual for men to be outnumbered in a real estate class. It is unusual to have 25 and there only be one. You know, but to his credit, he does well with it. He rolls with the punches, so he does. They give him a hard time. All right, so when we talk about owning a home, home ownership is definitely impacted by, or income taxes are impacted by home ownership. This is one of the major benefits of home ownership, is that you get some taxation benefits that you don't get if you rent. So this is going to be a conversation you probably will have with a client. Now, it's not giving tax advice to simply answer a question of, well, I heard if I buy a house it's going to help me on my income taxes. You can certainly answer that question. Will it help them on their income taxes to own a home? Yes, there is no doubt about that, because there are certain expenses related to owning a home which are tax deductible. Most of them center around the loan. Now, honestly, somebody who pays cash for a home is going to get less of an impact. We're going to talk about they still get an impact, they still get help, but it's going to be less of an impact. The big bang benefits of home ownership actually are related to the loan. We just came through financing, we did calculating interest, right? Those are some pretty big numbers. Those annual interest numbers. Well, interest is a tax deductible expense. So here's what tax deductible means. If I make $75,000 a year and I pay $15,000 a year in interest on my mortgage, I'm going to subtract the $15,000 from the $75,000, and now I only have to pay taxes on an income of $60,000. Does that make sense for everybody? That's what tax deductible is. It doesn't mean I pay $15,000 less in taxes. It means I reduce my income by that $15,000 and then pay taxes on that amount. But that's still going to be a substantial tax savings, because it's essentially $15,000 in free income. And the thing I always tell people is, you're essentially paying interest on a loan whether you own that house or not. It's just a question of, are you paying interest on your loan, or are you paying interest on somebody else's? Because if you're paying rent, aren't you usually carrying somebody else's mortgage as well? So give the tax benefit of it. So you need to know these things for the test. Interest on first and second homes is tax deductible. So you can have up to 2 homes according to the IRS, and believe it or not, the second one can even be a motor home or a boat, as long as it has sleeping quarters. As long as it has a bathroom and sleeping quarters, you can count motor homes and or RVs and or boats as a second home and deduct the interest. So for example, if you go buy yourself an RV and you take out a loan on it, the interest on that loan is also tax deductible. So that's just FYI. I'm not giving you tax advice, I'm just kind of broadening your horizons as to what's possible with a first and second home. So you don't have to show that you live there for any certain part of the year to qualify for that. So up to 2 homes, you can deduct the interest. Discount points. Well, it makes sense. If interest is tax deductible, it makes sense that discount points would also be tax deductible, because what are discount points? They're prepaid what? They're prepaid interest. And so discount points are going to be tax deductible. Remember, the thing with discount points is it's a one-time fee. So it's going to be deductible only for how many years? 1. Just that first year that you get the loan, the discount points are going to be tax deductible. Mortgage insurance premiums. Remember, we talked about if you borrow more than 80% loan to value, you're probably going to have to purchase some type of mortgage insurance, right? Well, the amount of money you pay for the mortgage insurance is also tax deductible. So if you get an FHA loan, for example, and you're paying that FHA mortgage insurance, that's also a tax deductible expense. So this really does start to add up. And then finally, loan origination fees. That's also going to be a one-time, one-shot deal the year you take out the loan. So if you get somebody, for example, who goes and purchases a house this year, they could get a very big one-time sort of tax break, especially if they buy discount points, if they pay origination fees, because they're going to get all that in 1 year. Does that make sense for everybody? That all hits at one time. And then, of course, year after year, they're going to be able to continue to deduct things like their interest and their mortgage insurance. Okay? Those are the benefits of having a loan on a home. You need to know them for a test. They're going to show up. You don't have to do any math about it, but you do have to be able to say this, this, and this are tax deductible if I have a loan on my home. Are we all good with that? Okay? Now, this break comes for all homeowners, whether you have a loan or not. Your annual property taxes are tax deductible, subject to certain limitations. I have to say that now with the new tax law. The new tax law caps how much of your property taxes are tax deductible, a certain amount. It's $10,000, which generally doesn't impact many people in our area unless they're in Chapel Hill. It does impact a lot of people in Chapel Hill because Chapel Hill has high tax rates. The tax rate in Chapel Hill is $1.76 per 100. So even on a $700,000 house, you could have a property tax bill of $12,000. Well, previous to the new tax law, that entire $12,000 would have been tax deductible. Now only $10,000 of it would be. So that is a change. You don't need to know that for the test, but just FYI, there is a limit on that deduction now. But it is a benefit that's available to all homeowners. So your property tax bill, for example, mine with Wake County was a little over $4,000 this year. That's a $4,000 tax deduction that I take, in addition to my mortgage insurance, I don't have mortgage insurance, but my mortgage interest, and any of those other things that I might have. Everybody okay with that? All right, good, good. That's pretty much it for homeownership. Everything else moves into the investment world when you start talking about tax. Income taxes, we don't want to talk about with investment property because that gets way too complex. Way too complex. The thing you need to know is what are they going to pay income tax on as an investment property in general? What number? What's the number? What's their income that they're going to pay taxes on an annual basis if they own investment property? Not gross. Before tax cash flow. Before tax cash flow. That's why it's called before tax. Because that's going to be the amount of money, the amount of income that they report to the IRS and pay taxes on an annual basis if they're an investment property. The big taxes we need to worry about, because they really involve us, are capital gains taxes. What's our major function in most transactions? Make people money, but when are we involved in most transactions? What's happening? When the property's being what? Sold. That's why we have to pay attention to capital gains taxes, because guess when capital gains taxes are paid? When the property is sold. A capital gains tax is a tax on a profit you make as a result of purchasing real property and then selling it at a later date. It is a tax on the profit. What's the profit? It's the difference between basically what you paid for it and what you sold it for. Does that make sense? And that profit is taxable, folks. That's called a capital gain. So if you ever hear of the expression a capital gains tax, well, the capital gains tax is a tax on that profit. And it's not just real estate. There are lots of capital investments. Stocks are capital investments, for example. If you own stocks or bonds, and you buy them at one price and you sell them at an inflated price down the road, you have to pay taxes on that profit. Does that make sense for everybody? That's a capital gains tax. And the important thing to know about capital gains is the tax is always paid when the property is what? Sold. You never pay it as long as you continue to own the property. The tax is paid when the property is sold, which makes sense because we couldn't possibly know how much the tax would be unless we've sold the property, because the tax is based on the difference between what we paid for it and what we sold it for. Does that make sense for everybody? So if I say to you, what's the basis of calculating a capital gain, what would you tell me? Take what two numbers? What I sold it for and what I paid for it. I mean, that's pretty much, see, if you can get that in your brain, then a capital gain makes sense. If you can get that idea in your brain, then a capital gain itself makes sense, because it's just a tax on the profit. Now, we're going to refine that down. It's not going to be just what I paid for it minus, what I sold it for minus what I paid for it. Because am I going to have some expenses when I sell it, for example? What's a big one? God, y'all don't think like real estate brokers yet. Commission. That's a huge expense of selling a property, is it not? So I don't want to pay taxes on that amount because I'm not keeping that amount of money. So we're going to refine down, but the basic idea is simply what I sold it for minus what I paid for it. Is everybody with me on that? Okay. So you need to know the difference between a short-term capital gain and a long-term capital gain. Well, the only difference is time. And here's the cutoff: 1 year. If you own the property for less than a year when you sell it, that is considered a short-term capital gain. And this distinction is important for taxation purposes. I'm sorry? Were you from D.C.? That's D.C.'s motto. No taxation without representation. Isn't it funny that they don't have representation? They literally live in Washington, D.C., and they don't have congressional representation. Isn't that crazy? You know, I never really understood what that license plate meant until I finally researched it. And, they don't have congressional representation. They pay federal income taxes, but they do not have any. They have non-voting representation. What the hell good is that? You know, but anyhow, one of those weird oddities if you live in D.C. Short-term capital gains are properties that you've owned for less than a year, from the time you purchase to the time you sell. Obviously, with real estate, are we mostly going to be dealing with short-term capital gains or long-term capital gains? Long-term. Think about real estate. Most of the time you own real estate for much longer than what? Than a year. So mostly we deal with long-term. Here's why the distinction is important. When you're talking about a short-term capital gain, the tax rate is much higher than it is on a long-term capital gain for most people. And that's why the distinction is important. For a short-term capital gain, the federal government just looks at that as the same as any other income. So if you're in a 25% tax bracket, what tax rate would you pay on a short-term capital gain? 25%. If you're in a 35% tax bracket, you'd pay 35% on a short-term capital gain. Whereas for the vast majority of Americans, long-term capital gains are capped at 15% taxation. Is there a big difference between 15% and 25 or 35%? Absolutely. So sometimes the best advice you might give somebody, like a house flipper, for example, if somebody's flipping a house and it's been 10 months since they bought that thing and they're ready to put it on the market, what's probably the best advice you can give to that person? Wait. We can put it on the market right now, but we can't close until you've owned this thing for what? More than a year. We're too close for you to pay 25 or 30 or 35% taxes on this gain, when all we got to do is get across that finish line of you owning this property for a year, and that tax rate drops to what? 15%. Do you understand why that distinction is important? So that's important knowledge for you to have as a real estate broker, the difference between a short-term capital gain and a long-term capital gain. Okay? So, and that's what this slide covers. Short-term capital gains are taxed at the regular tax rate, and that's different for everybody. I mean, like Omar's in the 35% tax bracket. We know what his is. You know, I'm in the 12% tax bracket. You know, so if everybody has their own tax bracket, and a short-term capital gain is going to be taxed at that number, whereas a long-term capital gain for almost anybody is going to be taxed at 15%. It can go up to 20% for the highest income earners, but you have to be a really high income earner for capital gains tax to go up to 20%. I believe the current number is $468,000 for an individual before your capital gains tax rate gets bumped to 20%. So for pretty much, I think it's something like 98.7% of all Americans, the capital gains tax rate is 15%. So for your reference, it's 15%. Now, you used to have to do these math questions. They have removed these math questions from the exam. And the reason they've removed these math questions is because it's become sort of an annual thing now to kick around this political football of where the capital gains tax exemptions are and what, you know, who's going to be subject to the 20% top rate and who's going to be subject to the 15% rate. So it's really become kind of problematic in teaching you how to do the math because it might change from year to year. So thankfully they have removed this math from the test. I'm going to show you the math examples so you know how it's done, because you will need to know the theory behind the math, but you won't actually have to do the calculations. Okay? All right? So when you calculate a capital gains tax, the first thing you have to know is the capital gain itself. You can't calculate the tax without knowing how much of a profit there was. Does that make sense for everybody? We need to know the profit. Well, we said profit is basically what I sold it for minus what I paid for it. And that's what you see right here, except we call what I sold it for the amount realized, and we call what I paid for it the adjusted basis. You need to know those two terminologies. You will absolutely see them on a test. The amount realized and the adjusted basis will definitely show up on a test. Now, let's talk about those terms. Amount realized is not just what I sold it for. What did I say we're going to have to do when we sell that thing? Pay some expenses. We got to pay commissions. We might have to pay property taxes. We might have to pay a closing attorney. Do we have to pay some closing attorney expenses? All of those expenses are going to be subtracted out of our amount realized. We're going to reduce the amount realized by all of those expenses. So, if I sold it for $450,000, but I paid a $20,000 commission, I'm not going to use $450, I'm going to use $430 as my number. Does that make sense for everybody? Because we're reducing that amount realized.
Write it off.
Essentially writing it off, right? Because it's money we never saw as the owner of the property. The other thing is the adjusted basis. That's not just what we paid for the property. The more correct way to describe the adjusted basis is what we have invested in the property. Because do we have other expenses associated with buying that property? Like what? Inspection fees, appraisal fees, attorney's fees. We pay all of that when we buy the property. That's money we had to invest. How about if we make improvements on the property? If we put a new roof on that property, or we put new HVAC system, is that an improvement to the property? That increases our investment. So all of those things that we do over the course of our ownership get added in. The whole idea here, think about this. We don't want a big capital gain, because a big capital gain is going to equate to a what? A big tax. The whole goal here is to minimize the gain when you're doing the math. Well, the way you minimize the gain is to get this number lower and get this number what? Higher. So you want a lower amount realized, you want a higher adjusted basis so that the gain is as small as it can possibly be. Because remember, we're going to have to pay 15% of that number as a tax on the day we close. Does that make sense for everybody? So, you need to know this formula. You need to know that the capital gain is equal to the amount realized minus the adjusted basis. you probably should also have a pretty good idea of what things affect the amount realized in the adjusted basis. Now, when you were doing the math questions, you had to know for sure that, for example, the appraisal fee would be part of the adjusted basis, or improvements would be part of the adjusted basis. But now you just need to know the generic idea of it, the basic formula. So if somebody asked you the formula for a capital gain, what would you say? Amount realized minus adjusted basis equals the capital gain. And that's going to be the amount we use to calculate the capital gains tax. So we would take that capital gain, and assuming we've owned the property for more than a year, we would multiply that number times what?
15%.
15%. And then that would be the tax that would be due. Loans don't matter, by the way. We ignore loans. When we're talking about capital gains, we ignore them on the way in and on the way out. We just simply don't care about a loan. We don't care how much you borrowed. We don't care how much you paid off. We don't care about the interest. None of that impacts a capital gain. We treat it as if it was a cash transaction for capital gains purposes.
Got nothing to do with taxes.
That's from a capital gains perspective, it certainly doesn't. Now, from an annual operating, it certainly, you write it all off. That's exactly right. Because it gets taken care of in that before tax cash flow formula, right? As a debt service. Yeah. But as far as capital gains, we do not care about loans. All right? So this is just an example. Again, you don't have to do the math, so I'm not going to spend a lot of time on this example, thank God. Okay? Travis purchased an investment property in 2005 for $150,000 and is selling it now for $228,000. So just roughly, we know my gain is a maximum of how much? I mean, what's the difference between those two numbers? What, $78,000? My gain can't possibly be more than $78,000 because I bought it for $150,000 and sold it for what? $228,000. So the maximum possible gain is $78,000. Does that make sense for everybody? Now, we're going to make it a lot smaller than $78,000 because we're going to start adding and subtracting from those numbers. So he incurred closing costs, attorney's fee, appraisal, and inspection of $1,500 when he purchased the property. So just to see where your head is, are those costs going to affect the adjusted basis or the amount realized? Which side are they going to affect?
Adjusted basis.
Adjusted basis. They're going to affect the basis because they're on the purchase side, right? The amount realized is the sale side. So they're going to affect the basis. He's done renovations to the property totaling $32,000. Again, is that going to affect the basis side or is that going to affect the amount realized side? Renovations. That's going to be on the basis side as well. So we're pumping that basis up with all those numbers. At closing, he's paying a 6% real estate commission as well as excise taxes of $456 and attorney's fees of $400. All those expenses, on what side are they going to impact? That would be the amount realized. They would all impact the amount realized. And then they ask what the capital gain is on the property. Well, if you go through and you do the whole thing, that's a $29,964 capital gain, which you no longer need to know how to compute. But you do need to know the terminology that gets you there. Yeah?
Because you told us the math before.
I taught the math.
My mind's going.
You're doing the math, right? And because you had to know the math before.
I was like having anxiety about this morning. I was like,
No, you don't have to do it. You just got to know the terminology. But I will say, those of you that have learned the math in the past, you're going to have a leg up on your brethren because you know the terminology already, right? So it's easier when you already know the terminology. The hard part for those of you that are taking the class for the first time is going to be focusing on learning the terminology without learning the math because you sort of had to learn the terminology as a result of doing the math previously. Now you don't have to do the math, but you still got to know the terms. And you got to know, for example, that renovations would go on the adjusted basis side of things. Does that make sense for everybody? Okay? So that's a $29,000 capital gain. Is that the tax that's owed? No. It would be times what? 15% to calculate the tax that's owed on that transaction. And so if you wanted to know the tax owed, that'd be $4,494.60 on that property. Right, we're going to get to why we might not necessarily pay that either. Because remember, the goal of taxes is to what? Avoid them. I mean, that's always the goal, any way you possibly can. But in theory, that'd be a $4,494 capital gain. And that would generally be paid by the closing attorney. You wouldn't even wait for the seller to pay that. Generally speaking, the closing attorney would cut that check right out of the closing and send it to the federal government. They don't rely on the seller to wait and pay it the following year. They don't trust you. That's exactly right. The IRS sends instructions to closing attorneys to calculate the capital gains tax due at closing, and they cut the check. Send the money.
How does the closing attorney know what kind of improvements?
You have to provide them with documentation of it. If it's a sale that's going to be subject to capital gains taxation, you have to provide all that documentation so that they can calculate it. Otherwise, what they will do is they'll do it based on the full amount and let you file an amendment later on. So what they'll do is they'll simply look at, well, here's what he paid for it 10 years ago, and here's what he's selling it for now. So this, because that's the maximum possible gain, and they'll take 15% of that number and send it to the federal government, and then when you file an amendment, you would get a refund of any amount due. So you really, it's to the seller's benefit to go ahead and give them the documentation up front and say, no, this is the correct capital gains tax. Everybody okay with that so far? Now, not working also. Not all transactions are subject to the full capital gains tax. There's one specific one, and you need to know this most assuredly for the exam. If there's one thing that they're guaranteed to ask you from this chapter on this exam, it's this slide right here. The reason that the vast majority of the American public knows nothing about capital gains taxes is that the vast majority of the American public never pays a capital gains tax. Because for the vast majority of the American public, the only real estate transaction they're ever engaged in involves their what? Their home. Their home. And for the most part, your home is exempt from capital gains taxation. Now notice I said for the most part. There is a limit to the government's generosity on this front. Most people, when they are selling their home, are not going to owe any capital gains taxes on that transaction. Because here's what the government says. If it's your primary residence, then the first $250,000 of gain, not sales price, but gain. I mean, think about, go back to our previous example here. I mean, we sold this property for $228,000, but we only had a gain of what? 29, so we weren't even close to hitting that number. It would take a pretty amazing turnaround on a house to have a $250,000 gain. Does that make sense for everybody? So this is a pretty big number exemption. And that's for a single person. If you're married, you get to do what? You get to double that exemption. So up to $500,000 in gain is tax-free on the sale of a primary residence. So generally speaking, when we talk about capital gains taxation for real property, what kind of property are we talking about? Investment property. We're generally talking about investment property. Now, are there homes that could fall into a category where they would still owe capital gains taxes? Yes. I've always been of the philosophy, if I have a $250,000 gain on my house, I'll be happy to pay you some taxes. Okay? And here's the thing. Just because I go over the $250,000 limit doesn't mean I owe all the capital gains. I only owe capital gains taxes on the amount above $250,000 gain. So if I have a $300,000 capital gain selling my house, I'm only going to pay capital gains tax on what? On $50,000. Does that make sense for everybody? So that's if I sell my primary residence. So here's what you need to know. You know the exemption now. Now you need to know the rule about what makes it a primary residence. Because the IRS does have strict rules about what qualifies as a primary residence. Remember, I said the rules about claiming interest deductions aren't so tight, right? This rule is tight. Because what they know would happen if they didn't have tight rules, somebody would sell a warehouse and say, oh, well, I sleep in there, in order to avoid paying the capital gains tax. So they do have very strict rules about what is a primary residence. And that rule, and it's easy to remember actually, because it's actually the same as our BIC qualification rule in North Carolina. The BIC qualification rule in North Carolina is that you have to have 2 years of active full-time experience in the previous what period of time? 5 years. Same thing here. You have to have lived in that property for 2 years full-time within the previous 5 years. Now, it doesn't have to be continuous. It could be a month in, a month out, month in, month out. As long as you can cobble together 2 years worth of residence in that property, then you can sell it as your primary residence. There are going to be times you have to give weird advice to people. What if you've got an owner who comes to you and they've got an investment home and they've owned it for, I don't know, 15 years, and for the last 5, they've leased it out. And you do the math, and they're going to have about a $300,000 capital gain when they sell this property. Now, if they've leased it out for the last 5 years, is it their primary residence? No, it's a what kind of property? An investment property. Well, how much? Do the math. What's 15% of a $300,000 capital gain? $45,000, right?
10 is 30, what's that half?
45 grand? That's a lot of taxes. Could they potentially avoid paying that tax?
Yes.
By doing what? Move in. For how long? 2 years. Could you present to them and say, well, you know, we can sell the house right now for you, or you could move into it for the next 2 years and save yourself $45,000 in taxes? Would most people be interested in that? Yes. Yes. It would certainly make you think, right? And so that's where knowing these rules can be really beneficial to you as a broker and to your clients. Does that make sense for everybody? You're going to see this on the test for sure. You're definitely going to see this exemption. So it's the first $250,000 of gain for a single person, first $500 for a married couple, but only if it meets that primary residence rule. This also comes into play when you have people who are getting married. If you have a couple who's getting married and they each own a house, sometimes you'll have a couple come to you and they're engaged and they each own a house and they plan to sell both of them and buy another. Does that make sense for everybody? They need to do that before they get married. Because you can only use this exemption once every 2 years. So if they get married first, now they both own both of those properties. Does that make sense? They're only going to get the exemption on how many of them? On one. On the second one, when they sell it, they would have to pay the capital gains tax. Whereas if they sell those properties before they get married, they're individual separate owners. They can both take the capital gains tax exemption, pay no capital gains, and then buy the house together. Does that make sense for everybody? So that's a huge piece of advice right there. If you come across those people who are in that situation, who are about to get married, and you know they're going to sell both houses, because that's a pretty common thing. It's always a bad idea for, get married and one move in the other's house. That's a weird power dynamic for most people, and so that usually works better if they buy something together. And so you'll be part of that a lot. And it's a great transaction for you because it's 3 transactions. If you get those people, it's 3 transactions at one time. Of course, you can also get them going the other way. When they get divorced and need to sell one and buy 2, you get them going and coming. So you just stay in touch with them over the years. The second one's a little bit harder to navigate than the first one, I will say that. I've done it. I have done it. Yes?
So you have the same scenario. One of the houses, 250, you wouldn't have to pay capital gains. Then the other person has a house that is going to capital gains are over 500.
Okay.
Over 250.
Okay.
Would it be best to sell the one that has the
bigger gain?
Less than 250, get married, and then sell that one to save on the capital gains on the other that would be above?
You're only going to get the 250 on the second one because one person has already used it for their 2-year cycle.
So if the other person moved in for 2 years,
then you get the 500. Yes.
Okay.
Then you get the full 500. That's right. That's right. So in that case, getting married. So if you had one, now that advice would change in your scenario. So let me give you that scenario. They own 2 properties. They're planning to sell both of them, right? But one of them has a $25,000, $30,000 capital gain on it, and the other one has a $700,000 capital gain. They need to wait until they get married to sell. because they need to take the capital gains tax exemption on the big one, and they need to take it as a married couple, because if they sell it as a single person, they'll only get the $250 exemption. They need to sell it as a married couple and get the $500. And you'd be happy to pay the capital gains tax on the $30,000 transaction to save an extra $250 on the other one. So yeah, you have to look at it on case-by-case basis. That would, that would be an interesting. Yep, for sure. And this happens also when people die. I've had this discussion. I had to have this discussion in a very tough way with a gentleman in Chapel Hill years ago. He and his wife bought a house on Franklin Street in 1958, and they paid $28,000 for the house. Now they've spent a lot of money on it over the years. I mean, they have an adjusted basis of like $220,000 because they've done a lot of renovations and stuff. But still, it's $220,000. The house is worth $1.5 million. So you're going to have a tremendous capital gain no matter what you do when you sell that house. Does that make sense? Well, his wife passed away. You only get a year after somebody passes away to sell it and still keep the married exemption. So we were having this discussion, and I said, truthfully, you really need to sort of make a decision pretty quickly, because if you wait another 6 months, you're going to have to pay capital gains tax on $250,000 extra dollars, because right now you could still sell it and take $500,000 exemption. Does that make sense? So just understanding this rule is a big deal. That's why we go over this. All right, everybody good on the exemption here? Okay, so you got to live in it for 2 of the previous 5 years as your primary residence in order to claim it for the capital gains tax exemption. And so this just is an example where you have a big capital gain. And in this case, we calculated the capital gain at $333,000. And because they were a married couple, that meant the first $500,000 was tax-free. Well, if you have a $378,000 gain with a married couple selling their primary residence, how much do they owe in capital gains tax? 0, because they're under the limitation. They're under the limitation. Okay. Now let's talk about how an investor might avoid paying this tax. And this is the other thing you're very likely to be asked about on the exam from this chapter. A 1031 tax deferred exchange, or just a tax deferred exchange. What does deferred mean?
Put off.
Put off, delayed. Delayed. Sometimes indefinitely. When do you pay a capital gains tax? When you what? When you sell. What if I told you you don't have to pay it when you sell?
Tell me more.
Tell you more. You can delay paying it. And the way you can delay paying it is by reinvesting the proceeds from the sale immediately in what we call a like-kind property. You need to know that phrasing, a like-kind property. Well, like-kind is a very wide-open interpretation. The IRS says like-kind means real estate for real estate. So any real estate sold and any real estate purchased. Here's the catch, though. You can't touch the money from that sale. Not $1 of it. You don't just have to reinvest the gain, you've got to reinvest every penny from that sale. Because as soon as you touch the money, guess what you got to pay? The capital gains tax. So you've got to reinvest every penny. If you're willing to do that, and you're willing to do it within their time frame, I said immediate, but you actually have 6 months to do it. Now you can't touch the money during that 6 months. It has to sit in an escrow account. You can't have access to it. I mean, this is a very strict process. But assuming you don't want to pay this capital gains tax right now, you can reinvest the money into another property, and you would presumably pay the capital gains tax when you do what?
Sell that.
When you sell that property. Or you could do what? You could do another 1031 exchange at that point in time. And so you might ask, what's the end goal? I mean, because all I'm doing is kicking the can down the road, right? Well, that's true. It's true. I am kicking the can down the road. Here's the light at the end of that tunnel, and it's a real bright light at the end of this tunnel. At some point, you're going to do what? You're going to die. When you die, under current tax law in this country, any real property that you leave as an inheritance to your heirs, they inherit it at market value for their adjusted basis, no matter what your adjusted basis was. Because remember, basically what you're doing by deferring the tax is you're kicking your adjusted basis down the road, right? You don't want to pay the difference between what you sold it for and what you paid for it. Well, your heirs are not going to inherit it with your low adjusted basis. They're going to inherit it as if they just paid cash for it at full market value, which means they can turn around and immediately do what with it? They can sell it, and what's their capital gain going to be? Zero. Because the difference between what they paid for it and what they sold it for is what? Is zero. So a tax deferred becomes a tax what? Completely avoided. It never gets paid. It never gets paid. Because when you die, that asset is transferred with a brand new reset adjusted basis. Does that make sense? So the tax is never paid. Yes?
So going back to the old man on Franklin Street, white guys. Well, if he just stayed there until he died, did that same wicked tree?
That was exactly the discussion we made. He wanted to move. He wanted to move to Florida to be close to his kids. I actually suggested that. I suggested he rent it out rather than pay all those taxes. Not what he wanted to do. Not what he wanted to do.
A sorority or something.
Absolutely. Absolutely. Because it would have been much better for him to leave it as an inheritance, because his children would have inherited it at the current market value. They could have turned around and sold it and paid nothing in capital gains taxes. You're going to have that discussion with clients. And some clients, I just sold a condo in downtown Raleigh, same situation. A guy owned an investment condo, he's 81. He sold the thing. He had a capital gain of like $120,000 on it, so he had to pay, not a huge amount of money, but still, it's almost $20,000 in capital gains taxes. And I looked at him and I said, do you need this money right now? And he said, no, I just want to simplify things. I want to have less stuff. I said, well, what are you going to do with the money? He said, I'm just going to put it in a trust fund and leave it to my sister's children. I said, well, just leave them the property. Yeah. Because if you leave them the property, then they can sell it, and there will be they'll end up with a better outcome versus you. Because if you leave them the money now, because he's paying the capital gains tax out of the proceeds. Does that make sense? So it's $20,000 that evaporates. It goes away in taxes, but that's not what he wanted to do.
Well, that's a financial decision. There's much more emotional decisions involved.
Absolutely. No question. No question. But do you guys understand the basis of a 1031 exchange? Now, you might ask, but what's the benefit for the person right now? There's actually a huge benefit for the person right now. Yes, they can't touch their money. I get that. And then that's a huge downside. That's the price you pay for not paying the tax, because you don't get to touch your own money. Because you can't even cash out what you originally invested. So imagine if I buy a property for $100,000 in 1965, and I just keep doing 1031 exchanges, well, 40 years later, I still haven't seen my $100,000 back, because I literally have to roll forward every dollar from every sale. But now I own a $2 million property, because is that possible over the course of 50 years with appreciation and those kinds of things? Could I easily have rolled that thing up into a $2 million property? Well, so now I've got this huge capital gain hanging out there, because I got a $2 million property and I only originally invested, what, 100 grand? Does that make sense for everybody? So obviously my children, my heirs are going to get a huge benefit, because they're going to get this $2 million property and be able to sell it and pay no capital gains taxes, no inheritance taxes, no capital gains taxes. It's a huge benefit to them. But we haven't talked about the benefit to me. And this is not on the test, but I want to show you why real estate builds wealth. This is how you build wealth in this country, because of the tax treatment of real estate. This is the best path. So this is going to be the best advice you ever get from a financial perspective. I am not your real estate instructor for the next 5 minutes. I'm just telling you how you build wealth. Right now, and probably not going to change anytime in the near future, when you do your annual income taxes as an investment property owner, you pay taxes on that before tax cash flow. Does that make sense for everybody? No, you don't. because you're going to tell the IRS that that property has depreciated. It has lost value, and you're allowed to do that. And there's no check against that. You simply tell the IRS that the property has depreciated. They will allow you to depreciate the property a certain percentage, and magically, what's going to happen is that you're going to say the property depreciated exactly the same amount as the before-tax cash flow that it produced. Well, gosh, yes, Mr. Federal IRS man, I did make $120,000 off this property, but poor pitiful me, my property depreciated by $120,000. So I'm a net zero for the year. I can't possibly pay you any taxes. That's 100% legal. So how much tax is going to get paid? Zero. Now, here's the downside. That depreciation reduces your adjusted basis in the property. So if you claim $100,000 in depreciation, your adjusted basis just went what? Just went down. Your adjusted basis went down. The amount you've invested in the property went down by $100,000. You following me so far? So let's say I pay $1 million for the property. It produces $100,000 in income for me. So I claim $100,000 in income to offset that. So I pay no income taxes. But now what's my adjusted basis in the property? It went down to $900, which means presumably when I sell it, I will owe more of a what? What kind of tax do I pay when I sell it? I'll owe more of a capital gains tax. But we've already discussed the fact that I'm not going to pay the capital gains tax, because what am I going to do? I'm going to reinvest it. I'm going to do a 1031 exchange. So here's what I'm going to do. I'm going to own that property for exactly 10 years. You know why I know it's going to be 10 years? Because every year it's going to make me $100,000, so every year I'm going to claim how much depreciation? $100,000. And after 10 years, what problem do I run into in year 10? What's my adjusted basis in the property now? Zero. Because I've depreciated it by $100,000 every year. Well, guess what? The IRS is not going to let you claim the property is worth negative money. So the next year, I know I'm not going to be able to claim any depreciation on that property. Does that make sense? So if I continue to own that property, guess what I'm going to have to start paying next year? Taxes. I'm going to have to start paying income taxes on that income, because I can no longer offset it with depreciation. Well, folks, I've gotten used to not paying any taxes on my income, and I'd like to keep that, thank you very much. I'm not talking about me, I'm just using it as an example, right? So, the solution is to buy another property, and not just any other property. I need one that's a lot more expensive, because I need room to do what? To take depreciation again. I need room to take depreciation, so I'm going to do a 1031 exchange. I'm going to buy a more expensive property. I'm going to finance the difference. And now I'm producing $200,000 a year in income. So how much depreciation am I going to take? $200,000. I'm going to write down to zero. So how much am I paying in income taxes? Zero. And I'm going to ride that until I've depreciated that property all the way down to what? Zero. And then I'm going to roll that forward, because now I'm selling a property worth $500,000. Oh, no, I'm sorry, worth $2 million. Now I'm going to roll that forward into the next purchase. And I'm going to purchase a $4 million property. And now it's producing $400,000 a year in income. And how much depreciation am I going to take every year? $400,000. And I'm going to depreciate that thing all the way till it's zero. And I'm going to ride that horse until what? Until I'm dead. Because when I die, I can leave that property to my heirs, and all that depreciation evaporates, because what's their adjusted basis going to be? No, their adjusted basis is going to be market value. Market value. So that when they sell it, the amount realized and the adjusted basis are the same number, so the tax is what? Zero. That's how you build wealth. Because when you hear somebody say, so-and-so doesn't pay any income taxes, well, when all your income is based on real estate, guess what? You probably don't. You probably don't. That is the power of investing in real estate. Okay? Yeah.
So let's say you sold at the end, like you did the exchange like 3 times.
Yep.
At the end, you only pay it the one time, the last one.
Mm-hmm.
It's not like you.
But it's going to be a huge one, because you're carrying your adjusted basis forward every time. So when you've depreciated all the way down to zero, but you sold that property for $2 million, what's your capital gain?
Full amount.
Is $2 million. So you roll into that next property already in a $2 million tax hole,
Still bucket.
right? So by the time you sell at the end, you might have a $10 million capital gain. So it becomes a point where you can't sell. There comes a point where there's no way in hell you can sell because the capital gain is so big that you are forced to hold on to this property until you what? Until you're done. But the benefit is all of that income that's been produced all those years has been what?
Income tax free.
Income tax free. Does that get your brain clicking in a little bit different direction right there? Yes, ma'am.
When you roll this 1031 into the next, like,
Exchange.
does it count as a down payment?
Sure. Well, because you're using the proceeds from the sale, right?
Right.
So you take, if I sell the property for $1 million, I'm not touching the $1 million. That $1 million is getting rolled into the next
It's all going
transaction.
towards the principal.
It's you're making it harder than it is.
Oh, I know.
It's $1 million, it's $1 million check with Christine's name on it, and you're saying, don't give it to me, put it toward that property.
Okay.
So now you have equity.
So now you have equity in that property. You don't have an adjusted basis, but you have a tremendous amount of equity in it. Now, it doesn't do you any good to exchange for the same price property.
Right.
Because if you exchange for the same price property, your adjusted basis is still what? 0. And you need to be able to take depreciation. So what kind of property are you buying next?
Much more expensive.
Much more expensive. Or you can buy multiple properties. You can split it up and buy, you can sell one and buy 5. You can do that.
Okay.
That's also allowed in a 1031 exchange. You actually have a 6-month time frame to accomplish this.
This is why somebody at 22, 24.
23.
23.
Start doing this now.
Yes, absolutely. Wish somebody had told me that when I was 23. I don't know what somebody told me at 23, but it wasn't that. But does that sort of make sense for you, though? You just, right there, you just got like, a big lesson in investing in real estate and what the advantages are right there. Because you can, once you, and I'll tell you all another secret. This is also not tax advice because I'm not your CPA. A real estate license is a wonderful thing when it comes to owning investment real estate. Because if you don't have a real estate license and you own investment real estate, that's considered passive income. So the only way you can offset it is with depreciation. Once you're licensed in real estate, all of your real estate related income is considered what they call active income. And what that means is that you can actually use losses that your investment property generates to offset your commission income. So for example, if I make $200,000 a year in commissions, but I own investment property and can I pretty much dictate showing a loss on investment property with depreciation? I can pretty much take as much as I want to, right? I mean, up to whatever their limit is for that year. So could I take enough depreciation on my investment property to not only offset the income it produces, but offset the commission income I earn as a real estate broker?
Double dip.
Yeah, like that.
What a wonderful country, right? That is the power of real estate. I mean, real estate receives treatment under the law that nothing else does. It just does, as far as taxation goes. Okay, are we good on this chapter? All right, that's it for chapter 18. So let's take a quick break, and then we come back and we get in chapter 21, closing the transaction. Yeah, Josh, start.
Is this the same idea? Because I know my granddad does this a lot. He's got a business where they do like development. What I know a lot of times what he'll tell me is a lot of the money that he makes when he sells property and stuff, he'll take that and just buy random ridiculous crap, I guess, and he says, oh, it's for the companies, that kind of the same thing.
Yeah, he's rolling it forward. He's doing a 1031
Buy
exchange.
like new equipment and stuff. They're like, why did you buy that? He's like, oh, I didn't want to pay taxes, so I bought.
Right. He's doing a 1031 exchange. And like I said, the definition of a like-kind exchange is pretty broad.
Yeah, just random.
Yeah.
stuff.
Right.
Just-
Same idea.
okay.
Same idea. Going with a 1031 exchange. Okay? All right, let's take a 10-minute break.
You're saying like time?
Like kind. K-I-N-D. Like kind.